Good morning, everybody, and welcome to our podcast today. Today, my special guest is Adam Hawryluk from Flawless Financing. Adam, how are you?
I'm well. How are you doing, Ian?
Excellent. Are you ready for the holidays?
Yeah. Yeah. Way ahead of the game.
Oh, come on, please. Nobody's way ahead of the game.
What else are we doing right now?
Yeah, fair enough. Fair enough. Now, have you had your annual Flawless Financing Christmas party?
We did. We went down to Melange and had dinner there. It was nice.
Nice.
Yeah.
Good stuff. Good for you. Now, Adam, obviously, mortgages is your business, your thing, your specialty. And we were talking before we got started about I was in Toronto last week and everybody was talking about mortgage rates and renewals. We actually had one of the speakers was Benjamin Tall,
Oh, awesome.
the vice
Yeah.
president, CIBC, I think.
CIBC's chief economist. Yeah.
Chief economist. Yep.
Yeah.
And he was talking about the tremendous pressure people are under for any number of things. Everything's expensive. We were talking about that, right? Food's expensive, gas expensive, and now mortgages coming up. And the angst is the right word I think people are feeling when
Sure.
they figure out that, hey, 2 years ago I was a hero and now I'm not so much a hero when I'm going to be renewing my mortgage. So, today I wanted to talk to you about, you must have people coming in talking to you about this, and how do you handle that? And what do you think people should do?
Yeah. It's absolutely, you're right. That's a big thing for people right now. A lot of concern about what they're going to end up with for payments.
Right.
Really, interest rates don't make that much of a difference for a person, only in the regards to how much my payment is going to be. So the good news is a lot of people that we're talking to have expectations that interest rates and their payments are going to be higher than what they actually are when we run through the numbers and say, like,
okay,
well, this is what you're actually going to be looking at. And they go, oh, I heard it was going to be like 8%. I'm like, no, actually, we can look at something around like 5.5 or 5.75 or something like that, and the payments drop accordingly, and that makes a big difference. So I'm glad to be on that side of the discussion,
right?
Versus I thought we were going to get in at 3.5, and it's actually 5.5. So yeah.
Now, when they're talking about 5 or 5.75, they're still qualifying 2 points higher than that, though, right?
On
Can you talk about that?
Yeah, on renewal, they actually just clarified that this year. If you currently have a mortgage that's CMHC insured, on renewal, you can still qualify at the contract rate, your new contract rate. So you're 5.75, not qualifying at the benchmark rate or the mortgage qualifying rate of contract plus 2%. So the government just clarified that earlier this year, which kind of made everybody's head spin of like, how is this not open knowledge earlier?
Now, what about that's just if you're doing the exact same amount. If I'm a move up buyer, I need more money. What happens then?
Yeah, you got a couple of different options. A person can look to either add additional funds to their existing mortgage or put a second mortgage behind their existing mortgage. If they were trying to if it's about interest rate minimization, you can transfer your current mortgage, say it's insured,
right,
at its current balance, and keep all those stats the same that gets you the lowest rates. And then if you just need a little bit more to top up because of that higher purchase price, you can get that topped up amount at today's interest rates, maybe that little bit higher of an interest rate.
So that's different than blending it.
Yeah. So then the other side, you could look at to either blend it. Other lenders will look at blending the interest rate, which is where you currently have a mortgage and you need more. You're not at your maturity. So you could look at a blended interest rate weighted on the balance of old money and new money. So you can absolutely blend it.
Okay. Would you say that as a rule, there are quite a few people coming to see you that are in this situation?
Absolutely. I mean, I would say less so people moving up right now. There's a less of a push for those people, but a lot of people who have been sitting with their interest rate for the last
So if somebody was bought in the last 3 or 4 years, 2 or 3 years,
or even 5 years ago, and their 5-year fixed rate is coming up for maturity, and they're being told by their bank or their lender, hey, here's your renewal options. you know, 5-year fixed rate at 7%, 3-year fixed rate at 8%. And they're like, man, do we have to have this? And we can look at other options around other lenders and see that there are better deals out there. And we look at how to take advantage of those better deals for them. So we've had a number of success stories in the last handful of months that have helped people save hundreds of dollars per month on their payments just by popping their head up and saying, like, is there anything else around? Like, is am I getting the best deal possible? So that's been really nice.
So the topic today was 2 things to consider when your mortgage is coming up. Let's get into that. What's number 1?
There's 2, the prism we have to look at always. The first one is, what are your plans? What's the plans for this property? What are your plans going forward? Is this a forever home? Is this for now? And then the second one is, what's your cash flow like?
Mm-hmm.
And how does that factor in? Really, with those 2 conversations, everything else flows through from that. So with an understanding of what your plans are in the future and how much you can afford, then we go into, okay, well, to support that, we can look at a fixed rate, or to support that, we look at a variable rate, or we look at a home equity line of credit, or we look at a reverse mortgage, maybe, if your cash flow is really poor, or you're really concerned about your cash flow. And then from there, we look at, okay, well, what's the interest rate that we're able to get in order to support your plans and your cash flow? So really, that's how the conversation would go, ideally.
If it's my personal residence, as opposed to an investment property, this is a condo that we own, and because we're hearing that from people that had a condo they bought for X number of dollars at a low rate, and of course your rent is fixed. You can't increase it, but your strata fees aren't fixed, and your taxes aren't fixed, and they're only going one way. So that situation is different than my personal residence, and that's where you're talking about this discussion makes sense, right?
Absolutely. Because then, are you planning on keeping that rental property? Is that a forever thing, or like is this a retirement assistance? Is this part of your retirement plan, or is this, I want to get out of it, cash out, and consolidate my finances? I don't want to be having strata fees or property taxes go up on me like this anymore. So yeah, that's all part of what's the plans.
Yeah, I think we're seeing more investors deciding this is the time to sell, which is driving prices down on condos. It's an interesting scenario, right? There's buildings with all investors and everybody wants to sell. Not everybody, but a lot of people do. And then the prices start coming down, and people are like, well, we had a couple that said, well, I'm just going to keep it because I'm not making enough money now, or I'm going to end up losing money if I keep lowering the price. I mean, valid concerns.
Absolutely.
Now, for my if it's my personal residence, it is going to be my long-term home. One of the options is always extending your amortization period.
Absolutely. Yeah.
How far can those go now? What are the options for people?
I mean, really, traditionally, you can go up to about 30 years. To go further than that, you're talking into B lenders, which are a little bit higher of an interest rate and potentially a fee, but you could go up to 35, let's say, in there. And then to extend that amortization even further, you're looking at things like reverse mortgages or home equity lines of credit, or those types, like the Manulife One or something like that, where you're really not making headway on the principal. You've got different priorities: cash flow, retirement, those kinds of things.
You mentioned reverse mortgages. You're seeing more of those.
Yeah. It's becoming more and more of a consideration for people as people age, and most reverse mortgages are available from 55 plus.
Okay.
And you're seeing people be able to at least have a conversation about them. What would it look like? Not even, I would say there's not a ton of people who are looking at taking equity out of their place they own free and clear, as much as it's people who are coming into retirement maybe with a mortgage of 100, 200, 300,000, and that wasn't the plan. maybe what life happens, right? Like there's
Does.
lots of reasons why
Yeah.
that goes on. And so then they're looking at, okay, well, what would things look like for my estate if I were to do this? And it can be a really good conversation.
Because there's always been perhaps a negative outlook on a reverse mortgage. Is that accurate?
Yeah, I think in years past they've been considered. I think it's twofold. One is that there wasn't a lot of lenders doing them, and they were at higher interest rates, and maybe not so in Canada, but definitely in North America, it was seen as kind of predatory because you're dealing with an aging population,
Yeah.
and the contracts weren't always set up in a way that would be mutually beneficial, let's say.
Right.
But in the last handful of years, more lenders have come to the table who want to be part of it. They see the value, they see the market growing in reverse mortgages, and so interest rates have come down. The contracts have become much more mutually beneficial, and also on the second side of that, I think people's headspaces have come around to the idea of like there might still be debt when I'm retired. I think in 10 years past, you wouldn't have had nearly as much of the population who had that as a consideration.
Well, and I think too, the reality is that we're living longer. And we talk about that, right? Good news,
absolutely,
you're living longer. Bad news, you're living longer.
Yeah.
When I was in Ontario, I went to see my mom. She's 97, right?
Sure. Yeah.
And hanging in there, and out of money.
Yeah. Yeah, I get it.
How else can it be?
The numbers were all set for an 85-year-old, like right for 85-year lifespan.
She just blew by that.
I
mean, she could easily live to 100. She's not sick.
Yeah.
She doesn't have any disease or anything. Knock on wood. We're fortunate that way.
Fantastic.
But still, to think that the average person can save enough money to live to 100 to any kind of a lifestyle thing is probably a stretch, isn't it?
And the other piece to that now is because housing has become so expensive and schooling has become so expensive, like student debt, that more people are helping their kids out.
Right.
Taking a $200,000, loan out of their estate to help their kids buy their first home is not something that they had in the plan, but it's, they're wanting to help get them into the market and get them settled. So, that's a bigger piece too.
Now that's coming up now too, as well. I'm understanding from some people that at renewal time now, not first purchase time, at renewal time, I can't afford this house anymore. So perhaps I need my parents to co-sign on it with me now. Are you seeing that, or another lump sum?
Yeah.
Something like that.
Yeah, I mean, we talk about it in a couple of ways. We look at obviously having parents co-sign, how that would make a difference for them, but a lot of times that doesn't make the biggest change because it's still the payments are too high. So for them to handle. So really what it comes down to is, well, maybe parents can help in other ways. Maybe if they were to gift a person, say $30,000, putting $30,000 on the mortgage principal doesn't make that much of a difference on your monthly payments.
Right.
But having a $30,000 buffer in your account can help supplement those payments pretty well to get you through your lean years, right?
And just as we wrap up here, I don't want too much of your time. I know you're a busy person. Are you saying that someone coming in today, it's end of December, it's December 2023, we look into the future? I know it's hard to forecast the future, but is a 2-year term a good way to go? Because all the chatters about rates coming down 24, 25 ish, rather than a 5-year term. What are your thoughts on that?
Yeah, I mean, really, it comes down to that prism that we talked about first: is what are your plans and what are your cash flow? For a lot of people, a shorter term makes a lot of sense, but if you can't qualify for it, we can't take advantage of it.
Right.
And the interest rates are higher than a 5-year. 5 years are lower interest rate right now. So
they just came down under 5, didn't they?
Some lenders. Yeah, I mean, you gotta really thread the needle to be able to qualify for that. But it's good news. But it makes headlines for sure.
It's a headline nobody can get.
Yeah.
Oh,
Yeah. So, but yeah, I mean, really, a lot of our clients, what we're seeing and encouraging are the 3 years right now are in
okay.
a price point that is comparable for qualifying as the 5 year. They're only off by, say, 0.75%. So it's really not that big of a jump, whereas the 2 years are quite a lot more expensive.
Quite a lot more.
Yeah. So we're seeing a lot of people who can qualify for and are going for a 3 year versus a longer term fixed rate.
Okay.
Yeah.
Awesome. Adam, as usual, the very best. Now, the best advice, if this is happening to you, is to get a second opinion.
Absolutely. It's free. It takes nothing. Even if you can't qualify somewhere else, it doesn't jeopardize your ability to renew with your current lender. So there's no harm in taking a look and seeing
Right.
what else is out there. I always say, having financial problems is a lot like choking in a restaurant, right? Like and ideally you would slap the person beside you and they would help you. But a lot of people get embarrassed about it, and it's not, it's not
Yeah.
sightly, and you kind of scurry off to the bathroom to hopefully deal with it yourself.
Right.
Really,
That's a good analogy. Yeah.
just slap the person beside you and say, like, hey, what would this look like? Like, things are tough. I'm scared of what's going to happen here. We'd be more than happy to answer any questions like that, or go through a person's option, just like any other mortgage broker here. But really looking at your options is going to be in your favor.
Awesome. And how do we get a hold of your team?
Info@flawlessfinancing.ca, or you can always call at 250-591-9959. Yeah.
Fantastic. As usual, my friend, Adam Hawryluk, Flawless Financing. Thanks for joining me today.
Thanks for having me in.
Have
Appreciate
a great day.
Yeah, you too.
Okay. Bye-bye.
Bye-bye.